Group is a listed company, financial services group. We have a balance sheet of about 25 million of capital. We're managing portfolios for clients for about 200 million under management, and we run a valuation service for about 2,000 members. So we value stocks, and members of the public and managers of self-managed super funds can value companies using our service. What's becoming a major issue overseas, bond markets are predictive of where economies and equity markets are going to go. The bond market in America in the last 3 or 4 months has had a sustained rally. Rallies in bond markets can be good news and they can be bad news. This is actually quite bad news. The yield on a 10-year bond has fallen to about 2.75%. We're seeing yields on bonds in Japan fall below 1%, bonds in Germany fall below 3%. So we've got a view in the bond market that inflation is not an issue, that growth is going to be very benign, and now we're looking at the risk of deflation, which is a fall in the general price of goods and services over time. Now, if we start seeing falling in prices, it's going to have an effect on economies. The focus now is America. What would deflation look like? Deflation would have the effect that it would slow down the economy. For instance, companies which trade in goods and services, why would they stock up an inventory if that inventory would fall in value? So you'll see companies destocking or holding back stock. If they do that, production is not created because there's nothing to service. If production is not created, the high unemployment we're seeing in America could be sustained for a lot longer than we expect. If people are unemployed, they don't consume, they don't pay tax, and you get this vicious circle being created. If it's not broken, then it could become a long-term cycle, as we've seen in Japan, with quite devastating effects on equity markets. The Japanese equity market is still only about a third of its value that it was 20 years ago. So that's the effect it can have. We're investing in Australian equities. We're an Australian long-only equity manager. Deflation here, if it comes to Australia, it'll come via America, Europe, Asia, back to Australia. So it's got a long way to go before we get it. But you've got to manage your portfolios on the basis that it can come here. And the Australian equity market is going to be affected by offshore events anyway. So equities in Australia are valued on world markets. So what we're doing is looking at building up yield. You've got to have yield to offset the potential for little or no capital gain in the market. That's quite confronting. Clearly the Australian market hasn't seen something like this before. Certainly the American market is grappling with the issue. The fact that companies can grow earnings might not be reflected in their share price going up. So yield's important, sustainable yield is also important. So you just don't want to buy yield today, which goes away tomorrow. So you want to find companies who are paying a reasonably good yield and can sustain it. Those companies have sustainable return on equity. So it's just not profit, it's profitability. You want to see companies which can deliver a high sustainable profit on the equity that they're employing. So the features are high yield, sustainable profitability, and a sustainable business case. So they're the things we're looking at. Well, that's exactly what MyClime allows investors to focus in on. Profitable companies. Now, profitable we mean by companies which have a high return on equity and a sustainable return on equity. And we'd find those companies because on our filtering process, in the Australian market of over 2,500 companies, it's interesting to note that less than 500 companies have sustainable profit. So they've made a profit in each of the last 5 years. It's only about 20% of the market. Then you want to try and find the companies which have sustainable profitability at a level which justifies an investment in them. And we say that level is around 20-25% sustainable. And looking for the companies which have 5 years of sustainable return on equity, you're probably down to less than 100 companies. So you don't have to look far. MyClime allows you to find those 100 companies very, very quickly, and then we filter through for their valuation. MyClime values the stocks. Then we compare the valuation to price. If there's a significant discount to the offered in the market against the valuation, then they become stocks of interest to build portfolios. As an asset manager, we use MyClime to identify the stocks to build our portfolios. MyClime allows members to do the same. The stocks which we're focusing on are the highly profitable companies, the high return on equity stocks, which are trading at a discount of some sort to their price on the market. The stocks which we're showing up now are mainly the banks. The banks are recovering quickly from the GFC. Australia didn't suffer the recession which the rest of the world did. The bank stock prices are trading as if they are foreign banks, not Australian banks. They're not being given the credit for their balance sheet strength and the strength of the Australian economy. So we're seeing value appearing in the four major banks. Of the four, the deepest discount in price to value would be National Bank. And that's probably a function of the potential AXA acquisition, which is holding its price down. In the retail sector, we're seeing a value in Woolworths. Its profitability has been sustained through the GFC. So despite a slight downturn in Australia, Woolworths powered on with return on equity well above 30%. JB Hi-Fi and the Reject Shop are two other companies which are showing very high return on equity. JB Hi-Fi is in value after its result it announced yesterday, which was up to market expectations, and the outlook was okay. Outside them, it's smaller companies. Macmillan Shakespeare is one which is rapidly rising in the share market up towards our valuation. It's a salary packaging company, but its return on equity is being well over 50% sustainable. And then you get down to the mining companies. It's quite interesting that BHP, which is the major company in Australia, is in value. Its return on equity is sustained well over 30%. Very strong balance sheet. The valuation is around the mid-$45 mark, and the share price is about 40, so it's in value as well. Mining services companies like Monadelphous feature, and finally Telstra, which everyone hates. Stock price is being held back with the political issues at present, but it's in value by about 10% and has a fairly high yield of about 8% franked. So it comes into that feature which we talked about earlier as something to offset deflation. The process has worked. It's worked not only over 12 months, it's worked over 2 years. The 2009 market was a negative market for about 20% down. Our portfolios delivered positive returns. In the last 12 months, the market's risen by around 13%. Our portfolios have risen by over 20%. So we held capital together in a bad market and we compounded capital last year. So that performance is pretty good.